Hello. So this will be our first lecture on audit and assurance paper. In the last video, I spoke about the summary of the syllabus, where I told you that audit and assurance paper is just like a project that can be divided into 3 different groups. Planning it, you do it, and you report it. And I said everything you do from planning to execution to reporting is guided by regulations and audit framework. And this is section A of your syllabus. This is your section B, your section C and D, and this is your section E. So we're starting with the regulations. So I'm going to be speaking about audit framework and regulations in this framework and the regulations in this recording. Yeah, so this is what we'll be looking at today. But before we go into details of the framework and regulations, it's very important to understand key concepts, and I'll start with the concept of assurance because that's what the paper is all about. We'll talk about audit and assurance paper here. I don't like to assume you understand everything, so I'm going to try and break everything down for you because audit paper is not difficult, but if you don't understand the words, the terminologies, you might struggle to pass the paper. So that is why I need to make you understand terminology so that you can use the right word and understand the differences between those words that seems to look alike. Audit and assurance are not the same thing. Audit is an activity, is an exercise when you try to gather evidence, you're trying to probe, you're trying to investigate. So you're probing here. When you're doing an audit, you're probing. Yeah. However, when you're talking about assurance, you are trying to convince someone. Yeah. Someone is trying to get a confidence. Yeah, about something. It's trying to get some kind of satisfaction. Yeah, like certainty. He's trying to find that peace about a particular thing. So let me give you an example. You want to buy a product on Amazon. I'm sure all of you do this. The first thing you want to do, especially if you have never bought that item before, you want to go straight to reviews. You want to check what other people are saying about that product. What you are looking for is an assurance. So you are looking for assurance, but the activity of looking for that assurance is audit. So take for instance, you going to click on rating 5, rating 1 and see why is it rated 1, why is it rated 5. The activity is called audit. That is a procedure you are carrying out. However, what you are looking for is called assurance because you want to have comfort. Right? That's another word. You want to have comfort. You want to have satisfaction. You want to have confidence that this item is good. Also, maybe you want to buy a house. The seller tells you, I'm selling this house for you for $20 million. And you're wondering, should I be paying $20 million? You don't know. But few things you will do. Either you are trying to get the price of houses in that area, or you might even get an expert to go do a proper valuation for you. What you are trying to do is to get assurance. So all those are assurance concepts. We do it every day. Everybody. The vehicle papers, what travel, MOT, vehicle license, all those things you do. What the government is trying to do is to get assurance that your vehicles are working properly. So assurance is something that we all engage in every day of our life. Yeah. So now you understand the concept of assurance and audit. Audit, remember, is the activity. The outcome is the assurance. That's what you are looking for, right? But to get assurance, you need to perform an audit. Right. So now you understand the concept. The next thing is, let's now take it to the business world, which is where it is very relevant for this paper, business world. Why are we talking about assurance in the business world? We're talking assurance in the business world because the owners of the business, called shareholders, have invested in company. However, they don't work inside this company. They don't know what is going on in this company day-to-day basis. They only engage with this company most likely maybe once a year during AGM. And this once a year is not even enough to get confidence on what is going on with the company. The company is being supervised by the agents, called the directors, and the management. So, for shareholders to have comfort, to have confidence that this company is operating the way it should operate, what do? They now get the help from people called auditors. So the shareholders call on the auditors to say, please help us look into this company and let us know whether they are performing well or not. Because the company will always prepare financial statements to give to the shareholders. But how will shareholders know that the figures in the financial statement is correct? How do they know that the figures in the financial statement has not been manipulated? To get that comfort, to get that confidence, shareholders needs to get auditors. And what auditors will give to the shareholders is the assurance. And that assurance can be either that the figures are okay, that means they are correct, or they are not correct. So it's either it is a good outcome or it's a bad outcome. And that is what you get in the report of the auditors. So that is the assurance concept. It's because the shareholders want to have confidence in the financial statement that the company has provided during the AGM. And that is why they need the support of the auditors in order to do that. Yeah. Quickly, let's talk about the elements of assurance engagement. So that's assurance engagement I just broken for you quickly. So let's look into elements of an assurance engagement. There are usually 5, and you must know them because very examinable. Element of assurance engagement. Element of assurance engagement is just looking at what are the things that are involved, the major things that are involved when you are talking of assurance engagement. The first thing that comes to your mind is the subject matter, which is we are talking about what are we actually auditing. Yeah, subject matter. That is, what are we auditing? And you can guess what we are auditing. That is financial statement. So very important. We need to know that. Yeah, what we are auditing. Then you think about what are the people involved? Who are the people involved? People involved. And there are 3 people involved in this. First of all, the shareholders who appointed the auditors. Very important. Yeah, shareholders and other users. You can say and other users, but majorly shareholders. But other users can also benefit from the engagement, because if someone wants to invest in a company, the potential investor might be interested. Even government might be interested because of their tax, right? So users of a financial statement, but majorly shareholders who actually appointed the auditors, right? Then who is going to do the work? Auditors themselves that was appointed. They're also involved. They're part of the people involved. Then also, who is being audited? The management and directors. Responsible party. Right. So those are the 3 people involved. Yeah. Then when we finish the audit, when we finish the audit, definitely we will talk about the audit report. That's also the outcome of the audit. Very important, audit report. Yeah. Then the last two is this way the work is being done, which is talking about the standards. Yeah. So the ISA, which is audit standard, because we cannot do any audit without the standard. Very, very important. Yeah. And documentations, which is the work of the auditors, where evidence is being kept. So very important to know these elements, very examinable. That is very, very important. Right. Now, let me quickly mention this, that usually there are two types of assurance. Now you know the meaning of assurance. Now I want to talk about the types of assurance. Types of assurance. There are two types. There is positive assurance and there is negative assurance. And they are different. And please listen carefully. Positive assurance is an assurance that tells shareholders. Remember, we've moved to business-related assurance now. Yeah. So, positive assurance is a very high level of assurance, which means is more convincing. Yeah. And you can rely upon it better than negative assurance, because in this case, you are telling the shareholders that you have looked at the financial statement and you can tell that the financial statement is true or it is not. So you are telling the shareholder, the auditors are telling the shareholders that they have done all the work that needed to be done, and they can tell you that there is no error, significant error, or there is significant error. Remember, the fact that there is significant error doesn't make it a negative assurance, because students get it complicated there. I'm going to explain what negative assurance is. So keep negative assurance away. What positive assurance is able to do is able to give high confidence. That is why it's called positive assurance. High confidence, yeah, whether financial statement is significantly true or is not true, which does not represent true and fair view. So there is high confidence to give the outcome. Outcome can be positive or negative. Outcome can be bad or good. Let me put that so that I don't confuse with negative assurance and positive assurance. Right. However, negative assurance is not able to do that, because there is not so much work that will be done. In positive assurance, you do a lot of work for you to be able to give high confidence, you imagine. But in negative assurance, you don't necessarily have to do so much work, because all you have to say is that nothing. Instead of saying you have done all the work in positive assurance, in negative assurance, you only say nothing has come to your attention as an auditor, right? Nothing has come to our attention. So now let's speak like an auditor now. Yeah. So we say nothing has come to our attention. Yeah. That suggests error. That's what you are saying in negative assurance. If you want to provide negative assurance, you don't need to do all the work. You just need to do little work, and during your little work, if nothing has come to your attention, yeah, nobody can hold you for it. So it's like, let me give you an instance. It's like you standing in front of the building and someone is asking you and say, oh, is there anybody left in the building? You don't know. But there are two things you can do to be able to answer that question. You can decide to go into the building and check every room to be sure that nobody is in the room. Then you can come out and answer and say, I have checked all the rooms and I can tell you that nobody is in the room. At the same time, you can decide to answer the question by saying that standing from where I am here, you can peep from outside and say, well, I can't see any movement inside the building. So you can answer straight away that, no, I've not seen anybody. I don't think I've seen anybody here. So I don't think there's anybody in the room. Or nobody, I've not seen anybody in the room. But you've not done the work. So that is negative assurance. When you say, I have not seen anybody. But when you say, I've gone into the room and I've checked all the rooms, I can say there's nobody in the room. You are giving a more convincing answer. That's a positive assurance. But when you say, I've not seen anybody in the room, you are giving a negative assurance. Because I've not seen anybody in the room doesn't mean that there's nobody in the room. It's just that you're saying, I have not seen. So nothing has come to our attention that suggests error. That's a negative assurance. And it's very important to understand the concept of materiality in audit. Extremely important, mostly important, materiality. The same way you have materiality concept in accounting, you have in audit. In fact, it's even more important in audit because that is the basis of the outcome of audit. And why is this important? Because you can never audit 100% of financial statement. You can't look at every single number in the financial statement. It is not possible. If you have to do that, maybe you have to do the audit for 1 year because the transactions happen from January to December, 365 days. You can't go to an audit client and start reviewing everything. And that is why you never give absolute assurance. Never. Please take note. In fact, a warning. Never give absolute assurance. What you give is called a reasonable assurance. Reasonable assurance. And it's called reasonable because you are only focusing on significant items. Focus on significant. Remember, the word materiality is the same thing as significance. And what does it mean? Materiality means an item is said to be material when changing that number is huge enough to change the decision of the users of account. If that number is big enough to influence the decision of the users of financial statements, then you say that item is material. That is the definition. And in audit, that must be quantified. And we'll get to that, how that is being quantified when we get to planning. Here we're still talking about the framework. So I'm laying the foundation. This lecture is meant to lay the foundation for you, right? So this is about the foundation. So materiality here is just talking about significance. So you're only focusing on significant items, and because of that, you cannot give absolute assurance, but you can only give reasonable assurance because you have only focused on significant items. And so the type of assurance that we are focusing on for this paper is called the positive reasonable assurance. So we're not looking at negative assurance in this paper. This is our focus. Positive and reasonable assurance. But that doesn't mean that you shouldn't understand the meaning of negative assurance, because you can be asked in exams to differentiate between the two. Yeah. And here, our focus is on external audits. Remember, there are two types of audit. There's external and there's internal. Internal audit is done by the staff of the company. External audit is done by a third party. So external audit is who you are. You are an external auditor. So our focus is on external audit, which is also called the statutory audit because it's mandatory for listed entity. This is a statutory audit, right? So that is what we're looking at. And when auditors have carried out this external audit on the client, the outcome is a report. Yeah, is a report. It's called the audit report. And in the audit report, what auditors put inside, which everybody is interested in seeing, there are different paragraphs in this audit report. But the most important paragraph, yeah, is the opinion paragraph, which is where the result of the audit is the opinion paragraph, because it's the opinion paragraph that states whether the report is good or the report is bad. Yeah. And what does the opinion paragraph usually say? It will say that so we are the auditors, so in our conclusion as auditors, yeah, say financial statements gives true or fair view, or they can say does not give true or fair view, yeah, of the state or affairs. So state financial statement gives true or fair view of the state of the company affairs. This is basically the opinion. So this is a good one. Everybody wants to have this if everything is fine. But sometimes it might not be as good as this, which is the opposite. Financial statement does not give. But sometimes auditors can also come out and say we cannot even express opinion, the disclaimer. And we'll get into all those types of report. But I just want to build this general understanding. But what is the meaning of true? What is the meaning of fair? It's just about error, right? So you are saying there's no bias when it is fair. You are saying there is no material error, no related party manipulations, and all this opinion is given in materiality. So it's material. That is what is being looked at to give this opinion. We only look at material items. So the opinion is saying that the financial statement gives true and fair view. Yeah, it's based on materiality. Another way to put it is that the financial statement is free from all material errors. That is the same thing they are saying. Free from all material errors. So please take into consideration those concepts. The types of engagement, we say there is negative assurance, there is positive assurance. I focus on positive assurance, and that positive assurance has to be reasonable assurance, because we don't do 100% audit. We only focus on material items. So you give a reasonable assurance. Yeah. And it's good to also touch on the users of financial statement, yeah, or stakeholders of financial statement, which I initially talked about. Who are the stakeholders? Yeah, let me not call you SH, so you don't get it confused with shareholders. Stakeholders are the same thing as the users. So when we talk about the stakeholders of financial statement, which you must know, yeah, stakeholders or users. Yeah, we have the lenders, you have the shareholders, you have suppliers, you have customers, suppliers, customers, even staff and employees. They are also interested in the performance. Governments are also interested. Yeah, government want to know what is going on with the company because they want to collect tax, right? Yeah, and maybe you can have other people, other public, yeah, agencies. Yeah, but this one's very important. Please take note. Yeah. And like I said, you need to know that we don't give absolute assurance, and we only give reasonable assurance. Yeah. Very good. Good background there. When I say we don't give absolute assurance, we only give reasonable assurance, that should definitely brings something into your mind, and that is the fact that we are limited. So there are limitations to audit, because we are not able to give 100% assurance. We only give reasonable assurance. So what are those limitations that we face? Because there are definitely limitations. And the first limitation you need to understand is the fact that management are responsible to prepare the financial statement. Yeah. So management prepare the FS. It's a limitation because they want to prepare it and make it look as good as possible. They don't want you to come as auditor and start bringing out error. And they are involved in the operation of the company from beginning of the year to the end. So they know the company more than any auditor can ever know it. Yeah. So that's another limitation. Auditor does not, participate in the affairs of the company from beginning of the year to the end. And likewise, auditors don't test 100%. We don't test 100% population of data. We only focus on material items, right? So it's not possible for us to be able to. We do sampling, so we can't do sampling and say we want to give absolute assurance. So that's why we don't give absolute assurance. Yeah, we have limitations, and these are the limitations. Yeah, likewise, auditors are not responsible for preventing fraud. Management are responsible and not responsible. Please take note. For preventing fraud. Only management are responsible to do that. So it's management responsibility. So difficult for auditors. Yeah. Likewise, safeguarding asset is not auditor's responsibility. It's management responsibility. So management has a lot of responsibilities, and you cannot now put all the responsibility on the auditors and expect auditors to come and give an absolute assurance. So those are the limitations, and that is why we don't give absolute assurance. We can only give reasonable assurance. Also good to quickly mention regulations. Regulation, I've mentioned it before. Audit and assurance is regulated by ISA, which is called International Standards on Auditing. Yeah, please don't confuse this with IAS, which is International Accounting Standard. This one is International Standards on Auditing. So this is for audit, and this is issued by IAASB. Remember, in accounting is IASB, but this one is IAASB, which is International Audit and Assurance Standard Board. Audit and Assurance Standard Board. That's IASB. Yeah, very important. And it's good to just know that. So every audit we do is guided by ISA standards. And these ISA standards are many. They are all focusing on different things. Take for instance, you see ISA 315, we will see soon. It's about identifying risk of material misstatement by understanding client and his environment. You have ISA 240 on fraud. You have ISA 320. You have ISA 215, ISA 200. So there are a lot of ISAs. But in this paper, you are not meant to memorize the ISA numbers, but the few ones you can know is good to be able to state it in your exams if you are asked. Yeah, but most importantly is to understand what ISA requirements are, and not necessarily cramming or memorizing the number. Yeah, so very important.